In this video, we're going to explore how we can kind of set the stage, if you will, for trying to determine what the optimal capital structure of the company might be. Again, as I referred to earlier, even if we do determine the optimal capital structure, there could be things inside the firm that cause the company to change that value one way or the other based on personal preferences. So let's start our discussion. The capital structure, right? That's the mix of debt, equity, right? How do we finance the company at a point where the stock price is maximized? So this trades off higher expected earnings return on equity, right? Higher profits up to the company and earnings per share against higher risk. So the tax-related benefits are offset here by the debt's risk-related costs. So what does that mean? Well, when you borrow money, there are benefits to borrowing. That is offset by the riskiness of investing, of financing using debt capital. So the target capital structure of a company is the mix with which the company intends to raise capital. That's the goal of the company, if you will. So why do bond ratings and the cost of debt depend on how much debt you borrow? Hopefully that's not too difficult to understand, right? As a company borrows more, it increases financial risk. That financial risk is incorporated into the analysis of the company, and the bond rating is going to decrease as the riskiness of the company rises, as that implies the potential chance that they won't be able to make interest payments, and therefore that they might default on the debt. So let's think about how companies might go about this. So we want to look at what happens to a company when they recapitalize. So let's take a company that has zero debt, and then we're going to convert that company's capital structure to reflect different levels of borrowing. So how do we do that? Essentially, the company is going to issue debt, they're going to borrow some money, and they're going to use that money to buy back stock. Now, if you notice in our discussion here, we haven't talked at all about assets. This has absolutely nothing to do with the left-hand side of the balance sheet. It has nothing to do with the assets of the company. So the operating leverage, right, the business risk of the company will not change. The only thing that's changing here is the financial risk of the company. So here we have this company. Here's the amount that they borrowed from 0 to 1,000. Here's their debt to capital. We've done that calculation again for a previous company we have. You see it goes from 12.5% to 50. And the debt equity ratio goes from 0.143% for 250,000 in debt, clear up to 100% for a company. This company, if it had $1,000, so it has $2,000 worth of equity, and it's going to borrow 1,000 here. So we have in this relationship down here, we have $1,000 of debt and we have $1,000 of equity. Now, what has happened is we borrowed more. The publishing companies, the investors, are going to see that as higher risk, and they're going to alter the cost of financing, the cost of debt that they want. So how does this affect the company? Well, let's start off with a company with zero debt. What is the earnings per share of the company if it had zero debt? We take EBIT minus the cost of financing here, In this case, we have zero debt, so that is 0. Multiply it by 1 minus the tax rate. Then you divide that by the number of shares outstanding. So for this company and zero debt, it has $3.75 worth of earnings per share. So what happens if they borrow $250,000? Again, the cost of debt is 8%. So how much are they going to repurchase? $250,000 is the debt. $25 is the price per share of stock. So they're going to buy back 10,000 shares. So now what's the earnings per share? Well, now we have what? $400,000 minus. Well, now we have interest, 8% of 250. That amount in brackets there, multiplied by 1 minus the tax rate. Now divided by the shares outstanding, remembering that now we have 10,000 less shares. Earnings per share just increased to $4.07. What about TIE? EBIT divided by the interest expense. We now have interest, so TIE now is at 20 times. What happens if we go to the extreme and we borrowed that $1 million? Again, at $1 million, the cost of financing is 14%. We're going to buy back 40,000 shares. Earnings per share is going to increase even more to $4.88. And EBIT divided by interest declines even further to 2.9. So what have we seen in these brief little examples? As we borrow more and more money, the cost of financing goes up. Earnings per share goes up. The number of shares that we have obviously goes down because we're repurchasing that debt. And in the end, we also see that TIE, our ability to handle the amount of debt we have, also declines. So again, what happens? If level of debt increases, companies' risk increases. We've already seen that increase. What happens with that increase in the cost of debt? However, right now, we also haven't really talked about everything with respect to the risk of equity, right? If the risk of equity is increasing, we also now have to understand that there is a higher cost of equity. All we've really done so far is shown that there is an increase in risk. So now we have to figure out what happens to the cost of equity. We know what happens to the cost of debt. Now we have to explore the cost on equity. We do this with a formula that's referred to as the Hamada equation. The Hamada equation looks at the company's beta if it had absolutely zero debt. So this company that we have right now, we haven't refinanced anything yet. So what we've done is we said, look, at zero debt, what is the beta of this company? And of course, what happens then as we change the financial risk? That's going to have an influence on the overall riskiness of the company, and we're going to have to adjust the beta to now reflect levered beta. So what does this formula look like? The beta of a levered company equals the beta of an unlevered company multiplied by 1 plus, now this is 1 minus the tax rate, times the debt equity ratio. So if the company has a risk-free rate of 7.5%, the market risk premium is 6%, the unlevered beta of the company is 1.25%. And we were previously told, right, invested capital we had was $2 million. So let's see what happens to beta when we change and go from a company that has zero debt to a company that has debt. So if debt goes from 0 to 250, we need to adjust our formulas, right? We need to calculate. Now that the company has debt, we have to have a levered beta. So you take that unlevered beta, multiply that by 1 plus 1 minus t. Now we need the debt equity ratio. We're borrowing 250. There was 2 million before, so now 1750 is what is in equity. So the new beta of this company would be 1.38. If you plug that into our security market line formula, we're going to have a new cost of equity of 15.8%. What happened when you borrowed money? The company became riskier. We see risk goes up for what? It goes up for everybody. The risk because of debt goes up, so the cost of debt goes up, obviously. The cost of investing in the stock goes up. The company is more risky, so the cost of equity is also going to go up. So we can do this calculation then for each of these five possible capital structures. Here's the debt to capital ratio, the debt to equity ratio. We've calculated that before. Now we're looking at levered beta. As we borrow more and more money, the beta of the company increases because we're looking at the beta, the levered beta. We also then, since beta is increasing, we also see increases in the cost of equity. The next couple of videos, we're going to need to incorporate this then into trying to understand how do we find the optimal amount of debt, right? We want to find in this group of capital structures which one is going to provide the maximum price. And that's coming in future videos. Look forward to seeing you next time.